Imagine throwing, well, the absolute biggest party of your life.
Yeah.
You've hyped it up for years.
Right, the event of the decade.
Exactly. And you finally invite the wealthiest, most powerful people on Wall Street. And they actually show up in their tailored suits. But then, and this is the crazy part, everyone just stands around the dance floor, completely terrified to make a move.
Yeah, which is a really bizarre paradox. Because that is exactly what is playing out in the crypto market right now. Wall Street finally bought into the spot that Bitcoin ETFs, institutional money has officially arrived.
But at the exact same time, the fear and greed index is just flashing extreme fear.
Right, because the structural dynamic of the market has fundamentally fractured. You have this massive influx of traditional finance architecture, but the price action is behaving like a wounded animal.
Yeah, the signals are completely crossing each other.
Exactly. It's creating an environment where retail investors and institutional quants alike are just questioning if the fundamental mechanics of crypto have broken.
Well, welcome to today's custom-tailored deep dive. We are tearing into a massive market analysis report from OscarAI today and cross-referencing it with institutional data from Grayscale, Fidelity, and taking a hard look at some recent academic studies from the IMF and the SSRN.
Which is a heavy stack of research.
It really is. And our mission for you today, on July 10th, 2026, is to cut through the relentless doom posting and, frankly, the toxic hype on social media. We want to answer one specific question for you. Is the current crypto bull cycle dead, or are we just witnessing a brutal, prolonged breather?
And to even diagnose the current market, we have to look at the sheer scale of the recent correction. We are currently watching Bitcoin fluctuate in this really tight, suffocating dam between $60,000 and $65,000.
Yeah, today it's hovering right around the 63 to 64,500 mark.
Right, which coming down from those dizzying blow-off tops above 120,000 back in 2025, sitting at 63,000 feels like a devastating collapse to anyone who bought that local top.
Oh, absolutely. And we are seeing sustained outflows from the spot ETFs right now, plus just a general exhaustion across the space.
Yeah.
But to understand if the cycle is actually dead, we need to establish how the patient used to behave.
Yeah.
Before the suits showed up to the party.
Yeah, that's a great way to put it, because the pre-2024 historical precedent was governed by a very strict, mathematically rigid 4-year cycle, and it was driven almost entirely by the halving.
Right, the programmed reduction in block rewards.
Exactly. It created this predictable supply shock. The Fidelity and Grayscale reports in our stack heavily emphasize how this supply scarcity, when it collides with expanding global fiat liquidity, mapped out a super reliable 4-phase behavior pattern.
Okay, so let's break those down. You had your accumulation phase, which is where, the smart money quietly buys the absolute bottom of the bear market when there's blood in the streets.
Yes. And then the markup phase follows. That's the aggressive, violent price discovery upward as the supply shock actually takes hold.
Right, the fun part, which
Yes.
bleeds into distribution, right?
Yeah. The euphoric top, where the early buyers essentially dump their bags on retail investors who are just FOMOing in. And finally, you get the markdown phase.
The dreaded markdown, the cascading liquidations, and just that grueling multi-year bear market.
Right. And the hidden engine driving that markdown phase was always the miners. In previous cycles, miners were essentially forced to be massive, persistent sellers.
Because they operate on such thin margins, right?
Exactly. They're paying for electricity and hardware in fiat, so when the price started to slip even a little, they had to liquidate their Bitcoin treasuries just to keep the lights on.
Which dumped massive downward pressure onto an already weak market.
Creating those brutal 80% drawdowns we used to see.
But this is where it gets interesting. The data from OscarAI points at a massive paradigm shift between 2025 and 2026. The approval and scaling of the spot Bitcoin ETFs completely shattered that traditional supply and demand dynamic, didn't it?
It really did. The institutional inflows, even on an average day, they can entirely swallow the daily minted supply of Bitcoin. The miners are no longer the primary source of sell pressure.
Wall Street's rebalancing algorithms are.
Exactly. The balance of power shifted from the producers to the accumulators. We have massive institutional asset managers now holding hundreds of thousands of Bitcoin, and they don't panic sell because of a bad CPI print the way a highly leveraged retail trader would.
Right. They're managing risk across a globally diversified portfolio. So it really is a total paradigm shift. Like I said, pre-2024, the market was a wild party drunk on retail FOMO. Now Wall Street showed up in suits with calculators.
Yeah, but they're still participating in the chaos, which is the wild part.
Exactly. If these institutional heavyweights are here providing a supposedly stable floor with their massive pools of capital, why are we seeing such brutal market corrections? Why is the momentum completely stalled out at 63,000 today?
Well, because institutions are actively de-risking right now in July 2026. And the on-chain data paints a very clear, very stark picture of this. If we look at the bearish technicals currently dragging the market down, the first thing that jumps out is the 200-day moving average.
The classic 200-day, Bitcoin has been trapped below this long-term trend line for months now.
Right. And historically, when an asset spends a fiscal quarter suffocating below its 200-day moving average, it's not just a dip. It signals a structural momentum shift favoring a moderate to severe drawdown.
The psychological weight of that trend line is immense. I mean, every time the price action tries to rally, it gets immediately rejected at the $67,000 resistance level.
Yeah, the market is completely boxed into a corner, just clinging to support around 60 to 61,000. And when you look at the CryptoQuant Bull Score Index...
Wait, remind everyone what goes into that index?
Sure, it's a metric aggregating network velocity, active addresses, and transaction volumes. And right now, it's practically flatlining. The bull score is sitting at around a 20.
Wow. And it needs to be, what, above 60?
Exactly. A healthy, continuing bull market requires that index to hold above 60. A score of 20 indicates that the network is essentially a ghost town. Retail participation has dried up, the on-chain velocity of money has plummeted, and the institutional ETFs, which were the primary demand drivers, have posted weeks of consecutive net outflows.
So the suits are actively pulling capital off the table. They're looking at the macro environment, calculating their risk, and hitting the sell button.
Yeah, they are.
That paints an incredibly bleak picture. I mean, if you stop the analysis there, you'd assume the 4-year cycle is completely dead and we're careening toward a multi-year bear market. But, and this is crucial, the OscarAI report surfaces some massive bullish undercurrents that completely contradict that death narrative.
Right. The contradiction really starts with the profitability of the circulating supply. Currently, only about 45% of the total Bitcoin supply is sitting in profit.
Only 45%.
Yeah. And this is a crucial metric. If we were truly at the end of a macro cycle, if the bull run was definitively over, we would see the classic signatures of a blow-off top.
You would see extreme blinding euphoria. Like in the tops of 2021 and 2025, we saw upwards of 90 to 95% of the supply and profit.
Exactly. In those moments, everyone is a genius, everyone is over-leveraged, and the market realizes a massive amount of wealth in a very short window.
But at 45% supply and profit, we are just in the middle of a chop zone. We are nowhere near the statistical euphoria that usually precipitates a structural, multi-year bear market.
Furthermore, the behavior of the coins themselves tells a story of quiet accumulation, not panic. Exchange reserves are consistently dropping right now.
Meaning investors are withdrawing their Bitcoin off centralized exchanges and moving it into cold storage.
Yes. When a market is preparing to capitulate, you see a flood of Bitcoin moving onto exchange and to be dumped. The current outflow to cold storage represents a massive tightening supply squeeze.
Which brings up, honestly, the most fascinating anomaly in the entire OscarAI dataset. We are seeing capital flow out of the Bitcoin spot ETFs, suggesting an institutional retreat. But simultaneously, the supply and transfer volume of stablecoins, specifically USDC, is hitting absolute record highs.
Yeah, we are seeing massive USDC minting right now. The liquidity isn't leaving the ecosystem and converting back into traditional fiat bank accounts.
It is just sitting on the sidelines in stablecoins, waiting for a deploy signal.
Right. The velocity of those stablecoins is the key to understanding the July 2026 market structure. Moving out of Bitcoin into USDC is a frictionless de-risking maneuver. It keeps the capital inside the cryptographic walled garden.
So it means there is hundreds of billions of dollars in dry powder just hovering above the market, waiting for a catalyst to fire back into risk-on assets.
Exactly. It's coiled up.
But that massive stablecoin liquidity is a double-edged sword, right? And I think it perfectly frames the ultimate bear versus bull debate for the rest of 2026. Let's dig into the bear case first, because if that stablecoin liquidity decides the macro environment is too toxic and leaves the casino entirely, things get incredibly dark.
Oh, absolutely. The bears are heavily betting that the post-2024 halving cycle is fundamentally exhausted. Their models project a cascade liquidation event driving Bitcoin back down to the $40,000 to $50,000 range.
Wow. And what's their primary thesis for that?
It mostly rests on market fragmentation. We are watching Bitcoin dominance drop, but we are absolutely not seeing a corresponding alt season.
Right. Normally, when Bitcoin dominance bleeds out, that capital trickles down the risk curve. It flows into Ethereum, then into the mid-caps, and finally into the microcap tokens, creating a rising tide across the entire ecosystem.
But today, that capital isn't flowing down, it's just evaporating. The altcoin market is severely fragmented, bogged down by regulatory crackdowns, and a complete lack of fresh retail capital to absorb the endless token unlocks.
And then you combine that internal structural weakness with the external macroeconomic gravity, right?
Yeah, we are dealing with persistent, sticky inflation data that just refuses to hit the Federal Reserve's targets. Plus, escalating geopolitical tensions, disrupting supply chains, and an incredibly hostile regulatory environment targeting decentralized finance protocols.
So the bearish argument is simply that the macroeconomic headwinds are too strong for Bitcoin to overcome, regardless of the halving.
That's the core of it, yeah.
It's a compelling and, frankly, terrifying argument. But the bullish counterthesis in the OscarAI report argues that the cycle hasn't died, it has mutated.
Right. Crypto cycles are notorious for executing brutal false tops, shaking out the weak hands with the 50% correction, and then triggering a massive extension rally just when sentiment reaches peak despair.
And the on-chain indicators absolutely support continuation here.
They do. The technical data strongly rejects the idea of a cycle top. Take the hash ribbons indicator, for example.
Oh, I love this one. Walk us through it.
So this model tracks the heartbeat of the network by monitoring miner capitulation. It compares the 30-day moving average of the global hash rate to the 60-day moving average.
And when the 30-day drops below the 60-day, it means miners are hurting, right?
Exactly. They are operating at a net loss, shutting down their unprofitable ASIC rigs, and dumping their remaining Bitcoin treasuries onto the market just to survive the squeeze. It represents maximum pain for the network.
But the critical signal fires when the 30-day moving average crosses back over the 60-day.
Yes. That recovery cross means the weakest, most over-leveraged miners have been flushed out. The surviving operations are highly efficient, profitable, and returning to accumulation.
And where are we at with that right now?
Right now, we are deep in the capitulation phase. The worst of the miner selling pressure is happening as we speak, but the recovery cross hasn't triggered yet. Historically, buying immediately following a hash ribbon recovery cross has preceded the most explosive legs of a bull market.
And the Pi cycle top indicator is telling the exact same story from a different mathematical angle, isn't it?
It is. The Pi cycle tracks when market behavior becomes irrationally exuberant. It plots the 111-day moving average against a multiple of the 350-day moving average.
Wait, the 111-day, why those specific numbers?
Well, the 111-day beautifully captures the aggressive, short-term speculative frenzy, while the 350-day acts as the historical, long-term ceiling.
Got it. And whenever the short-term 111-day moving average crosses above the long-term 350-day, it has flawlessly called the macro top of the market.
Usually within a matter of 3 or 4 days, yeah. It is one of the most reliable blow-off top indicators in existence.
And we are miles away from those two lines intersecting right now. The mathematical models tracking historical market tops show an asset that is currently cooling off, resetting its baseline, and preparing for another leg up. It simply hasn't triggered the exhaustion signals.
No, it hasn't. And we are seeing that baseline fundamentally reinforced by real-world utility that simply did not exist in previous cycles. The OscarAI report highlights the explosion of RWA real-world asset tokenization.
Yeah, we aren't just talking about speculative JPEGs anymore. We're talking about institutions like BlackRock bringing tokenized treasury funds on-chain. This provides a massive structural floor for the market.
The mechanics of RWA tokenization completely alter the markdown phase of the cycle. In the past, to earn a safe yield, capital had to fully exit the crypto ecosystem, moving through fiat off-ramps back to traditional banks.
Right, you had to cash out entirely.
Exactly. But now, institutional capital can park in a tokenized U.S. Treasury, earning a reliable 5% yield while remaining frictionlessly on-chain, deeply integrated into decentralized finance protocols.
It traps the liquidity inside the ecosystem,
Right.
preventing the devastating capital flights of the past. Which actually leads us perfectly to the most critical studies in today's stack, the academic research from the IMF and the SSRN.
Yeah, these are fascinating.
They really are. These papers definitively prove that crypto is no longer an isolated, uncorrelated asset class trading in a vacuum. It is deeply, structurally tethered to U.S. monetary policy and global equity markets.
It behaves like an extreme beta tech stock, highly sensitive to liquidity conditions. The correlation with the M2 global money supply is undeniable at this point.
So Bitcoin's internal localized clock, the four-year halving cycle, has basically been overridden by the global macroeconomic clock.
Precisely. It's an on-again, off-again relationship driven entirely by central banks. If the IMF's thesis holds true, we are no longer waiting for the halving supply shock to magically kickstart the market.
We are simply waiting on the sidelines for the Federal Reserve to pivot, cut interest rates, and flood the global economy with cheap fiat liquidity.
Because when borrowing becomes cheap, capital velocity increases, and institutional asset managers are forced to chase yield further out on the risk curve.
And that massive wall of USDC sitting on the sidelines will aggressively deploy back into Bitcoin the moment the Fed signals a return to quantitative easing.
Exactly. The halving merely restricted the supply, the Fed controls the demand.
The suits and their calculators are running the show, and they are reacting to Jerome Powell, not the Bitcoin blockchain. So, synthesizing all of this data from OscarAI, Grayscale, and the on-chain metrics, we can confidently answer the core question of this deep dive. Is the crypto bull cycle dead?
The data dictates that the cycle is absolutely not dead, but it has irreversibly mutated. 2026 is proving to be a grueling, prolonged transition year.
The market architecture is just maturing in real time.
Yes. The pure, unadulterated retail hype cycles of the 2010s are gone. The future price action is dictated by institutional accumulation strategies, macroeconomic liquidity, and the integration of real-world asset utility.
The game has changed, which means your strategy has to adapt. If you're listening to this, the golden rule based on today's intelligence is to abandon any attempt to predict the exact cycle top.
The macroeconomic variables are just too complex now, and the institutional algorithms operate way faster than retail sentiment. Trying to time the exact peak of this mutated cycle will get you liquidated.
Absolutely. Your focus must shift entirely to risk management and foundational research. Ignoring the noise of social media influencers and anchoring your decisions to verifiable data.
Track the metrics that actually move the needle. First, monitor the spot ETF flows. Wall Street's capital dictates the floor price.
Second, track the total supply and velocity of stablecoins. The moment that record-breaking USDC volume begins aggressively deploying into Bitcoin and Ethereum, you know the sideline capital has decided the bottom is in.
And finally, utilize on-chain analysis platforms like Glassnode or CryptoQuant. Watch the hash ribbons for that minor capitulation recovery cross. Relying on the immutable data of the blockchain is the only way to navigate a market environment this fragmented and contradictory.
It all comes back to following the liquidity. But before we wrap up today's deep dive, I want to leave you with a final, slightly uncomfortable thought to chew on. We've established that institutional demand, ETF flows, and the macroeconomic policies of the Federal Reserve are now the undisputed primary drivers of Bitcoin's price discovery. They have essentially neutered the internal mechanics of the halving cycle.
Traditional finance has completely consumed the asset.
Which presents a massive philosophical paradox. If Bitcoin's ultimate success and price appreciation are now entirely dependent on the liquidity injected by central banks and the approval of Wall Street asset managers, does that mean the ultimate decentralized rebel currency has finally become exactly what it was created to escape?
That is the question, isn't it?
Is Bitcoin no longer a revolution, but just another highly correlated traditional financial asset sitting in a BlackRock portfolio? We'll leave you to wrestle with that one. Thanks for joining us on this deep dive. Keep analyzing the data, stay grounded, and we'll see you next time.